friends, this is John Kingston from JR Trading Zone. This is a continuation video. Last video I made about option chain, how we find support and resistance using option chain. Okay, but option chain means it is a somewhat big subject because we should know the components in the option chain. First of all, you know option chain is having two parts, the call option and the put option. Traders trade the call option and put option. We traders are not allowed to trade in the index directly. We have to trade the futures or options contract. Okay, these are all contracts. Each and every strike will have one option and we have to buy or sell these strikes. Okay, these options. When you go to the option chain, you can find call option in the left side and put option in the right side. First, there are three types of options. One is out of the money, at the money and in the money. Okay, call options also you can see out of the money, at the money and in the money. In the put option side also you can see out of the money, at the money and in the money. What is out of the money? What is at the money? What is in the money? This is what we have to understand very clearly. When I started studying options, when I came to option chain and when I start studying the option chain, it was a bit confusing for me between call option and put option. But repeatedly when you hear the video, when you study from many other sources, it will be very easy for you to pick up one by one. Okay, that's why I'm saying not only my videos, you can follow a lot of traders, lot of YouTube videos who are explaining call option, put option, OTM, what is the ATM and ITM is explained by many traders and YouTubers. I am trying to simplify and I am trying to explain in the most simplest form. Okay, out of the money, at the money, in the money. Out of the money means all the option strikes which is out of the particular strike, that is called out of the money. In the money means all the options which is in the strike, that is called in the money. At the money means the center point between the OTM and ITM, that is out of the money and in the money. The middle portion is called at the money. One strike up and one strike down can also be considered as at the money. From the center, one strike above and one strike below can also, that area can be considered as at the money. I am going to make a small example. I will show in the computer, just you know how the option chain is, not a big deal, but even though I will show in the computer, but I want to make a presentation or I want to explain you how to understand this out of the money, at the money and in the money. Consider that you are having 3 mango trees in your what we say plot. Okay, 3 mango trees. One tree, the first tree is actually having mangoes in that at present condition. The next tree, flowers are slightly budding and small, what we say, small tiny tender mangoes are just being formed in the second tree. In the third tree, just flowers are seen here and there. Okay, but all these 3 mango trees belong to the same family. Each and every year, mostly these 3 may give same type of returns. Sometimes due to some climatic conditions, it does not happen too. Okay, generally you have seen many people in our village or in our place, vendors who come and offer some price for our mango trees even before the fruit is formed, even before the mangoes are formed in the mango tree. You might have all seen. Okay, it is a general thing. Most of the vendors come here, come and see where the mango trees are in there. They give a price and they book for the mangoes. Okay, now consider that one vendor, or let us take that in this present condition, we or you are a vendor. Okay, you are coming to my house or you are coming to my plot and you are now a mango vendor. You are seeing the first tree and you are quite satisfied because you are finding lot of mangoes in the tree. Actually, these mangoes in this present condition itself, it can be plucked and sold in the market raw. It can be used for pickles too. But if it ripes, okay, just after 2 weeks, consider after 2 weeks, if the mango ripes, you can get a better amount because fruit mangoes are much costlier than raw mangoes. So, what is your condition? You are ready to pay a good sum of money for me because you are seeing the mangoes are present in the tree. Okay, I am also getting a good sum of money for my first mango tree. Now, the second mango tree. The second mango tree, you are ready to take the second mango tree also. Okay, but when you are seeing the tree, you are just finding some small tender mangoes here and there. They are just coming out of the flower, and this is the condition of the second mango tree. Will you pay the same amount which you gave for the first mango tree? No. A vendor can never pay the same amount which he paid for the first mango tree. The reason is there is a lot of risk. Okay, if a heavy rain or storm is likely to come before the mangoes are getting big, surely it will be a great loss for him. So it will take more than 2 months to become a ripened mango. It is now just small tender mangoes, not like in the condition of the first tree. In the second tree, it is small tender mangoes. So you are paying half or even less amount as a advance. Okay, I am also accepting that because I also know there is risk. If a heavy rain or storm or something comes, this vendor might not get anything. In the third mango tree, just flowers are there. Tender mangoes are also not seen here and there. There are just flowers. It will take more than 4 months for the mango tree to give a good yield. There is lot of risk in the third mango tree. Not like the second one. Second one also there are small tender mangoes here and there. If there is a small rain or small wind, it won't affect that. Only strong wind and strong rain can affect it. But in the third condition, even a small rain, a small wind can shed all the flowers. So what will he pay? He will pay a very low advance because the risk is very high for him. Okay, these are the 3 conditions. In this condition, you imagine which is in the money. In the money means the first mango tree, because already the mango is in a condition within 2 weeks it can be plucked and sold in the market. He can ripe the mango and sell it as a fruit. Okay, he is getting little profit because he is paying huge advance or huge amount to the party. Okay, in the second case, he is paying just half the amount which he paid to the first tree because the mangoes are tender and it may take 2 months. There is a slight risk. If it works out, he is getting a very good profit. Why? Because he is paying just half the amount as the advance or half the amount as the total value. After 2 months, if it works out and if it ripens and if he is getting a good yield from the mango tree, definitely his profit is much bigger compared to the first mango tree. That is the at the money strike. Okay, at the money strike. First mango tree is in the money strike. Second mango tree is at the money strike. The third mango tree is out of the money strike. There is a lot of risk. There is lot of risk. It can happen or cannot happen. He is just paying a small token or giving a small amount. But if it works out, it will turn to be a huge profit. This is because he is just paying a very small amount in that third mango tree, isn't it? But if it works out, sometimes he may get 20x, 30x or even more. That will be a huge bumper for him. But the possibility is less. Okay, in out of the money. Now we have 3 types of options. Out of the money options, at the money options and in the money options. In the same manner you will have in the put option side also. In the put option also you are having out of the money, in the money and at the money. Okay, these are the difference between out of the money, at the money and in the money. Now carefully listen. In this particular area, out of the money, the date to expiry is very, very important. The date to expiry, if there is only 5 days or 1 week to expiry, all the out of the money options will go to 0. This is because in the money options will have an intrinsic value. All the out of the money options will have only extrinsic value. It is not actually having the value, it is given a value and it is called the extrinsic value. I am not going into the formula. If you go and Google, you can find the formula how to find the intrinsic value and extrinsic value. Another important case is implied volatility, which we called IV. For that, I will give you one simple example. I am making small examples because you should by heart the things which I am saying. IV plays a great role in the change of option prices. For this, I am taking a simple example. This example already I have told in my many videos. I am having a land in a particular area. Just the neighboring land is a government property and the government is ready to announce a medical college to be set up in that particular plot. What will be the valuation of my plot? You all know when a medical college is likely to be set up in the nearby plot, definitely the valuation of my property will go to 20x, 30x or even 100 times. There are much possibilities because it becomes a commercial plot. Now it is a residential plot. When medical college or institutions come there, definitely my plot is going to be a commercial plot. Okay, now the next scenario. A dump yard is going to be set up in this particular area. The same government property. Now the news is coming. A dump yard is going to be set up in this area. What will be the valuation of my property? The valuation of my property will fall half or even below. It will fall even below average and no one will like to stay in a plot near the dump yard. Okay, this example I have given in another 1 or 2 videos also. Okay, this is called IV spike, the news. Even though expiry or the date of expiry affects the option prices, a sudden news even multiply the strike to several times. Okay, that is called IV spike or implied volatility. It plays a great role in the change of option premium. Okay, now we have understand what is out of the money, at the money and in the money. Okay, how this in the money, at the money and out of the money is affected by IV. IV affects mostly the out of the money strikes. Out of the money will be valueless. It will be more or less, it does not have the intrinsic value. It is having only the extrinsic value, and as and when the option is going near the expiry, it will actually, when it goes to expiry, all the out of the money options will become zero. But when it is traveling towards the expiry, the premium will be fastly decaying, and at that particular time, if there is a news, definitely this strike will actually go several times on the upside. Or if it is a negative news, sometimes the premium will decay very immediately, will decay very fast. These two matters can happen, and that is called IV spike. That also plays a great role in the option premium, or it plays a great role in the fluctuation of the option premium. Okay, now what I am coming to tell. If you are an option buyer, you should always try to buy the strike which is having intrinsic value, because even though it is expensive, it can't go to 10 times, 20 times or 50 times, but it won't go to zero. Most of the people who come into the market go and buy out of the money options. He is a buyer, but he will go and buy out of the money options because it will cost very cheap, and out of the money options, when it goes near the expiry, when the day is already using, the premium will be very low, so they will go and buy out of the options. Out of the options, if it should yield to you, there must be IV spike. Without IV spike, all the out of the options will go to zero. Okay, clear? An option buyer, if he is not having strong conviction in the market, or if he is not knowing anything what is going to happen next, you should always prefer to buy the options which is in the money, or at least at the money. It also can give him a good yield if his view is correct on and his direction is correct. Okay, but in the case of option seller, the option seller should always try to sell the options which is having only extrinsic value, that is out of the money options. An option seller prefers always to sell out of the money options because he sells the premium, and when the premium goes to expiry, all becomes zero, and the premium collected is in his pocket. This is the view, and this is what an option seller does. Okay, but option seller and option buyer should always have a different perspective in the market. An option buyer can make a bumper by buying out of the options, but he should have the correct direction, he should get the correct momentum. He is confirmed, and he knows that the strike is going to move in this direction very fast, and there is a news to come, and definitely he can buy out of the money options and make money. But it does not happen all the time. Okay, a seller can make money by selling out of the money options, because always out of the money options becomes zero when it goes to expiry. There is also a negative side for the seller. If he sells out of the money options, and if there is an IV spike, it will become a great loss, and it will create a great loss for the seller. A seller should manage the risk, because always the risk is unlimited for an option seller. For an option buyer, the risk is the premium which he is paying to the market. These are the two difference between option buying and option selling. An option buyer just pay the premium and his risk is over. An option seller is paying the margin money if the position is not going in his side or not working in his side. If it is making an negative effect, definitely he is going to make a huge loss. Sometimes he will lose the entire money if he is not able to manage the risk properly. There is one famous saying, an option buyer should manage the reward, an option seller should manage the risk. Okay, so I will just show how the option chain is and where the option chain OTM, ATM and ITM is. A small presentation from the computer, and then I will go to the conclusion of the video. Type option chain. Okay, NSE derivative. Now let's give the symbol Nifty, expiry June 22. Let's select July 27, next month. Okay, now you see, this is how an option chain looks like. Call option this side, put option this side. Okay, I have made a detailed video how we have to analyze option chain. If you want, you can go and watch the video. Here I am just going to show what is out of the money, at the money and in the money. Now all these strikes, you see here, you can see a small color change. You can see a small color change. All the color strikes here in dark color is in the money, call options. Okay, this is out of the money, call options. This area, white area. Here just opposite. This is out of the money for put options and this is in the money for put options. Then what is at the money? At the money, the middle portion. We can take one or two strikes up and down. Just remind, dark color is in the money. For call options and put options, the dark color is in the money. And the white color here is out of the money, both for call options and put options. The center area is considered as the middle portion is considered as at the money. At the money strike in this present situation is 18,850. One strike above and one strike below. This area totally can be considered as the at the money strike. Okay, this is just about the OTM, ATM and ITM. That's all. Hi friends, now you understood what is OTM, ATM and ITM. Watch a lot of videos regarding options. I try to explain all in simple language and with examples. If it is useful for you, you follow the videos, and I have made a lot of videos using psychology also, regarding psychology also, that are all important videos. Go and watch each and every video. In this video, I just want to explain what is OTM, ATM and ITM. I have made two examples. One to explain the OTM, ATM and ITM with the example of mango trees, 3 mango trees. The next one example I made to explain the implied volatility. Okay, having a property, a government land, a positive project and negative project, how it can affect our land. Okay, that is the example which I gave for IV spike. Always remember the examples in your mind. Don't go behind formulas. Okay, for each and every thing, there are formulas here. For intrinsic value, extrinsic value, to calculate everything, there are a lot of formulas. If we are always trying to remind the formulas, you will fail to observe the logic. You will fail to see the logic in that particular area. So always remember the examples and watch a lot of videos, learn more, earn more. And this is John Kingston signing off from JR Trading Zone. Bye.